Life insurance is one way you can provide financial support for loved ones after you die. When you open a life insurance policy, you will pay a regular premium, often monthly or annually, in exchange for coverage. As long as your policy is active when you die, the insurance company will pay out a lump sum, also known as a death benefit, to the policy beneficiaries. Even though many life insurance policies work the same way, each type has significant differences that further define how they work. These differences can include how long the coverage lasts, if the policy includes an investment component, and whether or not you can access funds before your death. Understanding these differences can help you select the best policy for your needs. What does life insurance cover? Unlike other insurance policies, which typically dictate how the policyholder can use a claim payout, life insurance benefits can cover a wide variety of expenses. In many cases, policyholders invest in life insurance to replace their income and ensure that their beneficiary can meet financial obligations, including end-of-life expenses, such as funeral and burial costs, mortgage payments, tuition payments, personal debt, including outstanding loans or credit card bills, day-to-day expenses, like groceries. Financial obligations aren't the only way to use death benefit funds, however. Some individuals choose to open a life insurance policy to build an inheritance for their children or make a charitable donation to the policyholder's organization of choice. Depending on the policy you choose, you may also be able to use life insurance funds to manage expenses while you're alive. For instance, if you have a whole or universal life policy, your insurer will likely let you borrow against it to fund expenses like your child's college tuition or make a down payment on a house. However, keep in mind that if you do borrow against your life insurance account, the full death benefit may not be available if you die before paying back the funds. What doesn't life insurance cover? Life insurance covers most causes of death, including natural and accidental causes, suicide, and homicide. However, some caveats may prevent your beneficiaries from receiving their death benefit. Dr. Stephen Weisbert, who served as the chief economist at the Insurance Information Institute until his retirement in 2020, indicated that there are two common reasons why an insurer may deny a life insurance claim: a lapse in payment or misrepresentation of the policyholder's health. If the policyholder misrepresents or omits information about their health, insurance providers may deny a claim. That is particularly true during the contestability period, which is typically a 2-year window after the policy begins. In addition to those common causes, an insurer may deny a claim based on the circumstances of the death. For instance, if a policyholder dies by homicide, the insurer will likely deny a claim if the beneficiary is responsible for or involved in the victim's death. Life insurance policies also frequently include what's known as a suicide clause, which voids coverage if the policyholder dies by suicide within a specific period, often 2 years, after opening a policy. Finally, some insurance providers will deny claims if the policyholder dies while engaging in a high-risk activity, like skydiving, at their time of death. As such, it's important to discuss coverage limitations with your life insurance agent or broker before purchasing a policy. What type of life insurance do I need? Which type of life insurance you need depends on several factors, including your reason for purchasing a policy, your finances, and any investment goals you may have. Below are some of the most common life insurance policies available as well as when they may suit your needs. Term life insurance. A term life policy is life insurance that lasts for a specific period, typically from 1 to 30 years. During the term, the policyholder makes fixed premium payments in exchange for a guaranteed death benefit. Under a term life policy, coverage ends at the end of the term. However, some insurance companies allow policyholders to extend their coverage to another term or convert it to a permanent policy. Term life insurance is often the most affordable policy available. Learn more about term life insurance. Whole life insurance. Whole life insurance is one type of permanent life insurance. As long as the policyholder pays their premium, the policy will remain active their entire life. In most cases, the policy premium and death benefit are fixed, and you will pay the same premium as long as you have the policy. Whole life insurance also has a separate cash value component, which grows as the insurer pays policyholders dividends, a portion of the insurance company's revenue that is paid to policyholders. Policyholders may be able to withdraw from or borrow against the cash value portion of their policy to fund expenses while they're living. Based on our analysis of current life insurance costs, a whole life policy is typically more expensive than a term life one, but it may be a good option if you don't want a policy limited by terms. It also may be a good option if you'd like a savings component incorporated into your policy. Learn more about whole life insurance. Universal life insurance. Like whole life insurance, universal life insurance covers you for your entire life as long as you make regular premium payments. And, like whole life insurance, a universal policy has a cash value, but cash value growth depends on market growth. When market interest rates are strong, the cashback value of a universal policy will grow at a higher rate. The opposite is true when markets are performing poorly, the cash value will grow at a slower rate. Standard universal policies will usually have a guaranteed minimum interest rate. You can also borrow against or withdraw funds from this account to pay your premium or to fund expenses like weddings, educational expenses, or a down payment on a new home. Unlike whole life insurance, universal life insurance offers more flexibility because you can typically change your death benefits and premiums to accommodate changing circumstances. As such, universal life insurance may be worth considering if you're looking for a policy that provides more flexibility. Learn more about universal life insurance. Bottom line, though the policies above are the most common, today's robust life insurance market provides consumers with many policies to choose from, including variations of those listed above. For instance, some providers offer no medical exam. Life insurance is one way you can provide financial support for loved ones after you die. When you open a life insurance policy, you will pay a regular premium, often monthly or annually, in exchange for coverage. As long as your policy is active when you die, the insurance company will pay out a lump sum, also known as a death benefit, to the policy beneficiaries. Even though many life insurance policies work the same way, each type has significant differences that further define how they work. These differences can include how long the coverage lasts, if the policy includes an investment component, and whether or not you can access funds before your death. Understanding these differences can help you select the best policy for your needs. What does life insurance